Hello, welcome to Capital Sensei. Today, I want to take a step back and talk about the very beginning of my journey. I'm going to share the core lessons from the first book on investing I ever read, a book that fundamentally shaped my entire philosophy. It's called The Frugal Fortress: Building Wealth Brick by Brick by an obscure but brilliant German author named Tobias Schildfat. We'll break down his surprisingly simple yet powerful ideas, from building the right mindset to understanding what a stock really is, and how to patiently build your own financial fortress that can withstand almost any storm. As we go through this, you'll likely have questions, or maybe this will bring up some of your own experiences. Whenever we can, we answer questions in the comments. So please, feel free to share your thoughts, your doubts, and your own stories down below. Creating a community where we can all learn from each other is one of the best ways to grow. The first time I picked up Schildfat's book, I was expecting complex charts and incomprehensible formulas. Instead, the first chapter had nothing to do with money. It was about philosophy. Schildfat's central idea is that successful investing isn't primarily an intellectual or mathematical challenge. It's an emotional and psychological one. He argues that your biggest enemy in the market isn't a bad company or a recession. Your biggest enemy is the person you see in the mirror every morning. It's your own impatience, your own fear when prices fall, and your own greed when they rise. He uses the metaphor of building a fortress. You wouldn't build a massive stone fortress on a foundation of sand, would you? Of course not. The fortress is your wealth, and the foundation is your mindset. Before you even think about laying the first financial brick, you have to prepare the ground. This means cultivating patience, discipline, and a genuine long-term perspective. It's about understanding that wealth isn't a speedboat you race. It's a fortress you build, stone by stone, over decades, designed for resilience and permanence, not for speed and thrills. Schildfat wrote that most people fail not because they pick the wrong stocks, but because they have the wrong temperament. They buy high, caught up in the euphoria of a rising market, and they sell low, panicking during a downturn. They are reacting to the noise, the daily chatter of the market. The fortress builder, in contrast, ignores the noise. They have a plan and they stick to it, understanding that market fluctuations are like weather patterns around their fortress. Sometimes it's sunny. Sometimes there are violent storms. But a well-built fortress stands through it all. Once he establishes this psychological foundation, Schildfat moves on to the first practical step. And again, it's not what you'd expect. It's not about analyzing stocks. It's about building a moat around your fortress. And what is this moat made of? It's made of savings. He was adamant that you cannot invest your way out of a spending problem. The most powerful engine of wealth creation, especially in the early days, is not your investment return. It's your savings rate. The amount of money you consistently put aside is the raw material for your future wealth. Think about it this way. Imagine two people. Person A earns $50,000 a year and manages to save 20% of it, which is $10,000. Person B earns a much higher salary, say $100,000 a year, but only saves 5%, which is $5,000. Who is building their fortress faster? It's person A, by a long shot, despite earning half as much. Your savings rate is the one variable that is almost entirely within your control, and it has a more immediate impact on your net worth than anything else. Schildfat called this stockpiling the fortress. Before you go out on campaigns, meaning before you start investing aggressively, you must ensure your home base is secure. This means having a robust emergency fund, a cash reserve that can cover 3 to 6 months of living expenses. This is your moat. If an unexpected attack comes, a job loss, a medical bill, a car repair, you don't have to sell your fortress's bricks. your investments, at the worst possible time to cover the cost. Your moat protects your long-term plan from short-term emergencies. Only after drilling in the importance of mindset and savings does Schildfat finally turn to the act of investing itself. And his approach here is, again, beautifully simple. He demands that you make a critical mental shift. You must stop thinking of stocks as little flashing symbols on a screen with prices that go up and down. You must start thinking of a share of stock for what it truly is, a tiny piece of ownership in a real, living, breathing business. You are becoming a part owner of that company. He uses a brilliant analogy. Imagine a popular local coffee shop in your town. The owner decides they want to expand, so they offer to sell you a 5% stake in the business for $10,000. What would you do before handing over your money? You wouldn't just look at a chart of their daily profits. You'd visit the shop, you'd taste the coffee, you'd see if it's always busy. You'd ask about their suppliers, their rent, their employees, and their plans for the future. You'd try to figure out if that $10,000 price is fair for 5% of the business. Schildfat says you must apply this exact same thinking to the stock market. When you consider buying shares in, say, a big technology company or a car manufacturer, you are doing the same thing as buying a piece of that local coffee shop. You are becoming a silent partner. Therefore, you have a responsibility to understand the business. How does it make money? Does it have loyal customers? Does it have a strong brand or some other advantage that protects it from competition? Is the management team honest and competent? This leads directly to his core valuation principle, which is the concept of intrinsic value. Don't let the fancy term scare you. It's a very intuitive idea. Intrinsic value is simply what a business is actually worth, based on its ability to generate cash over its lifetime. It's the real value, separate from the market price, which is what people are willing to pay for it on any given day. The market price can be emotional and swing wildly, but the intrinsic value is more stable, rooted in the business's real-world performance. Think of it like buying a house. A house has an intrinsic value based on its location, its size, its condition, and the rent it could generate. Now, in a hot market, people might be bidding the price up far above that value. In a down market, you might be able to buy it for less than it's really worth. A smart real estate investor tries to estimate the true value and buy only when the price is reasonable or, ideally, cheap. A smart stock investor does the exact same thing with businesses. This is where Schildfat introduces what he calls the single most important concept in all of investing: the margin of safety. This idea, famously championed by Benjamin Graham, was the cornerstone of Schildfat's entire investment process. The margin of safety is a buffer against bad luck, mistakes, and the unpredictable nature of the future. It's an engineer's principle applied to finance. If an engineer is building a bridge that needs to support a 10-ton truck, they don't design it to hold exactly 10 tons. They design it to hold 30 or 40 tons. That massive buffer is the margin of safety. In investing, the margin of safety is the difference between the intrinsic value of a business and the price you pay for its stock. If you've done your homework and you calculate that a company's shares are intrinsically worth about $100 each, you don't buy them at $99. That's cutting it too close. A fortress builder, following Schildfat's advice, would wait until the price drops to, say, $60 or $70. That $30 or $40 discount is your margin of safety. Why is this so critical? Two reasons. First, it protects your downside. If you are wrong in your calculation and the business is actually only worth $80 per share, you're still okay because you bought it at $70. You have a cushion. Second, it provides your upside. When the market eventually recognizes the true value of the business, and the stock price rises from your $70 purchase price back towards the $100 intrinsic value. That's where your profit comes from. You're not gambling. You're taking a calculated risk with the odds stacked heavily in your favor. So how do you find these wonderful businesses to buy at a discount? Schildfat laid out a simple checklist. First, stick to what he called your circle of competence. Only invest in businesses that you can genuinely understand. If you can't explain how a company makes money to a 10-year-old in a few sentences, you shouldn't own it. For some, that might be technology companies. For others, it might be consumer brands or industrial manufacturers. It doesn't matter what it is, as long as you understand it deeply. Second, look for businesses with a durable competitive advantage, or what Warren Buffett would later popularize as an economic moat. This is some unique quality that protects the business from competitors, allowing it to earn high profits for a long time. This could be a powerful brand name, like Coca-Cola. It could be a network effect, where the service gets more valuable as more people use it, like a social media platform. Or it could be a low-cost advantage, like a massive retailer that can sell goods cheaper than anyone else. This moat protects the business's castle and its long-term profitability. Third, and this was non-negotiable for Schildfat, the business must be run by honest and capable management. Remember, you're a part owner. You need to trust the people in charge to act in your best interest. He advised reading shareholder letters, watching interviews, and looking at their track record. Are they transparent about their mistakes? Do they think like long-term owners? Or are they just trying to hit short-term targets to boost their own bonuses? Entrusting your capital to dishonest or foolish managers is, in his words, hiring an arsonist to guard your granary. Now, after all this preparation, the mindset, the savings, the business analysis, how do you actually go about laying the bricks or buying the stocks? Schildfat was a proponent of a slow, methodical approach. He despised the idea of going all in at once. Instead, he championed what we now call dollar-cost averaging. This simply means investing a fixed amount of money at regular intervals. For example, $500 on the first of every month, no matter what the market is doing. This simple automatic strategy does two wonderful things. First, it removes emotion from the buying decision. You're not trying to guess whether the market will be higher or lower next week. You just invest according to your plan. It enforces discipline. Second, it naturally makes you buy more shares when prices are low and fewer shares when prices are high. When the market falls, your fixed $500 buys more shares, which is exactly what a value investor wants to do. When the market is expensive, that same $500 buys fewer shares, protecting you from overpaying. He compared it to shopping for groceries. You don't try to time the market for apples. You just buy them every week when you need them. Sometimes they're on sale. Sometimes they're full price. Over the course of a year, you end up paying a fair average price. Dollar-cost averaging allows you to do the same thing with ownership in great businesses, ensuring you pay a fair average price over the long run without the stress of trying to be a market timing genius, which almost no one is. What about diversification? How many different companies should you own? Schildfat warned against two extremes. The first is owning only one or two stocks. This is too risky. If one of those companies runs into serious trouble, your entire fortress could crumble. This is reckless concentration. However, he also warned against what he called diversification, owning so many stocks, perhaps hundreds in different funds, that you have no idea what you actually own. Your returns just become a mushy, mediocre average, and the impact of your best ideas gets diluted to almost nothing. His solution was what he termed focused diversification. He suggested that for most individual investors, owning a meaningful stake in somewhere between 10 and 20 excellent businesses that you know inside and out, is the sweet spot. This is enough to protect you from a single company disaster, but focused enough that each position can have a real impact on your overall results. It's like his analogy of the fortress builder knowing every single stone in his wall, rather than having a vague idea of 1,000 distant fortresses. The final part of Schildfat's book brings everything full circle, back to the theme of the very first chapter: psychology. Once you've built your fortress, once you own pieces of wonderful businesses bought at fair prices, the hardest part begins: doing nothing. The final challenge is manning the walls, which means having the patience and fortitude to hold on for the long term, through thick and thin. The enemy now is not a bad business, but boredom and the constant temptation to tinker. He wrote that successful investing should be boring. It should feel like watching paint dry or watching grass grow. The excitement and action is what gets people into trouble. Once you own a great business, the best thing you can do is let it work for you for years, even decades. This is where the real magic happens, through the power of compound interest. Compounding is the process of your investment returns themselves generating their own returns. It's a snowball effect. Let me try to put this into perspective. If you invest $10,000 and earn a 10% return in a year, you have $11,000. The next year, you earn 10% not on the original $10,000, but on the full $11,000. So you earn $1,100. It's a small difference at first, but over 20, 30, or 40 years, this effect becomes an avalanche of wealth. A small snowball at the top of a very long hill becomes enormous by the time it reaches the bottom. The key ingredients are a decent rate of return, and most importantly, a very, very long hill, which is time. To truly benefit from compounding, you have to stay invested. This means resisting the primal urge to sell when the market crashes. Schildfat argued that market crashes are not disasters for the fortress builder. They are opportunities. They are the moments when great businesses go on sale. When everyone else is panicking and selling, the disciplined investor, with their prepared mindset and cash reserves, can go shopping for bargains, laying more bricks for their fortress at a deep discount. It's psychologically difficult, but it's where fortunes are made. He had a great line: the stock market is the only store in the world where, when things go on a 50% off sale, customers run out of the store screaming. It perfectly captures the absurdity of how most people behave. The fortress builder, in contrast, calmly walks into the store with their shopping list, ready to take advantage of the sale. They are able to do this because they know they own pieces of real, profitable businesses, not just lottery tickets. A 50% drop in the price of a great company doesn't change the quality of its products or the loyalty of its customers. So, in the end, what were the lasting lessons from the Frugal Fortress? It wasn't about complex financial models or secret formulas. It was a philosophy of life applied to money. First, master yourself before you try to master the market. Your temperament is your most important asset. Second, build a moat of savings. Your savings rate is your power. It gives you security and the raw material for investment. Third, think like a business owner, not a stock trader. Buy pieces of great companies you understand. Fourth, always demand a margin of safety. This protects you from your own mistakes and the world's uncertainties. It's the difference between gambling and investing. Fifth, be patient and let compounding do the heavy lifting. Time is the most powerful force in investing. Build your fortress slowly, methodically, and without emotion. Ignore the daily noise and focus on the long-term value of what you own. Reading that book didn't make me an expert overnight, but it gave me a compass. It provided a framework for thinking about money, risk, and wealth that was grounded in common sense and timeless principles. In a world that screams about getting rich quick, about the next hot trend, Schildfat's quiet, disciplined voice was a revelation. It taught me that building wealth is not a sprint. It's the slow, steady, and ultimately satisfying work of building a fortress, brick by brick. And that is a lesson that has served me well every single day since.